A monopoly. A monopoly is the next market structure in theory of the firm, and in many ways it is the polar opposite of a perfectly competitive market structure. A monopoly has a single or a dominant firm in the market, and when we think of a dominant firm, we think 95% of the market share or more. We think of a company with a unique product with no close substitutes. Monopolies are assumed to have very high barriers of entry, so it's not an industry that you can just come and enter as a new entrant. It would require significant investment and sacrifice. Think hundreds of millions of dollars to start a energy company or a search engine. You're going to have to spend a lot of money, a lot of resources, if that's even possible. So very high barriers of entry. And a monopoly is assumed to have high market power, and a monopoly is assumed to be a price maker. Think of Google, Meta, or De Beers as examples of monopolists. Google controls 95% of the search engine market. De Beers controls most of the global diamond supply, and Meta controls most of the social medias in the world, biggest social medias aside from perhaps TikTok. Let's look at the barriers of entry in greater detail. So monopoly barriers of entries are usually the following. Firstly, monopolies enjoy large economies of scale. So when a new entrant tries to enter the market, they'll be unable to compete with a monopolist because a monopolist has economies of scale, so they're able to produce at a lower average cost and a higher output. So a new entrant will have a higher average cost and a lower output, and they'll be driven out of the market. Secondly, monopolies could be a natural monopoly, whereby a natural monopoly is a phenomenon where one firm is able to produce and supply the entire market at a lower average cost than if there were two or more firms in that market. So the average cost is lower when there is one firm. Another barrier of entry that monopolies use is legal barriers. And this is stuff like market restrictions, things that kind of interfere in the market process, and that would be things like quotas, tariffs, or just straight up restrictions. For example, not allowing foreign competitors to produce goods. You could do that with proper restrictions or red tape or regulation. But there's also other types of legal barriers that firms can use to protect themselves. Monopolies oftentimes utilize intellectual property protection, and intellectual property protection would be things such as copyrights or patents. So if they have a design for a car, they would patent it. If they have a medicine that they want to patent, they would do something like that. Another example of a barrier of entry is branding, and this is stuff like brand loyalty, brand power, brand recognition, customer loyalty, so branding. Firms also utilize aggressive tactics, and aggressive tactics would oftentimes mean that a new entrant enters the market and the monopolist would try to compete with them on price. They would aggressively lower prices and try to drive the competitor out of the market. Or it could also be a hostile takeover bid. So they would try to take over the entrant. Also, firms oftentimes control resources. So if it is a natural resource company, they could have a monopoly over the gas fields or the oil fields in that country. If it is a train company, they could control the train grid system. So that is the last of the barriers of entry. These are the common examples that monopolies have to protect themselves. So these are usually the barriers of entry. Sometimes it's the firms themselves. Sometimes it is a phenomena like a natural monopoly. Having established the assumptions of a monopoly model and having understood the barriers to entry behind monopolies, we're now going to look at the diagram. What becomes apparent is that much like in the previous market structure of perfect competition, the marginal cost and the average total cost, which is average cost in some other classes, it depends on your teacher and the diagram, we could see that ATC and MC are the same shape as before. MC and ATC. ATC is parabolic, and MC is semi-parabolic. Just like before, we could see that the marginal cost intersects the average total cost at the average total cost's lowest point. So that is the same as before, but we do see that something is different now. What is it? Well, we could see that in the previous market structure, the demand and the price line was horizontal, and D was AR, was MR, was P. That is no longer the case, and we can see that the demand line is now downward sloping, so is the MR line, and the MR line is half as steep as the D line. So, what is the reason for that? The reason for that stems from price making and price taking abilities. In the previous market structure, in perfect competition, firms are price takers. Monopolies are price makers. So that is the reason why the slope is downward sloping. Having established that, we could see that the marginal revenue is twice as steep as the average revenue. We could see that the average total cost curve is U-shaped. Marginal cost intersects ATC at its lowest point. We established all that. Now we need to see where is the monopoly maximizing profits, because this is, after all, a profit maximizing firm. Well, if you recall the MCMR method, then we remember that profit is maximized where MC equals MR, and that would be at the intersection of the two curves. If this is the MR line and this is the MC line, they intersect here. So this is the profit maximizing quantity produced right here. So if this is our Q pi, this is our quantity of profit maximization, how do we find the price? Well, to find the price, we have to go up vertically all the way up to the D line, which is the average revenue line. The average revenue line, the average revenue curve, tells us the profit maximizing price, which is P pi. So this is the profit maximizing quantity, and this is the profit maximizing price. Again, the reason for that is because it is the point where MC intersects MR. So MR, MC equal here, and that is the reason why we choose this quantity. And to get the price, we have to go vertically upwards to get the price, vertically to the AR line, the AR curve. Okay, but how do we determine the level of profit? To determine the level of profit, we have to compare the average revenue and the average total cost at the quantity produced, Q pi. So at this quantity, the average revenue is P pi, while the average total cost is ATC. So this is our average total cost at this level. So the area where we're making supernormal profit is this square / rectangle. This is our supernormal profit area. There we go. So, because of barriers to entry, this supernormal profit area will remain there in the long run, because there is no market entry like you have in perfect competition, so this profit will remain in the long run. So this is a short run and a long run situation. Now let's talk about allocative efficiency. Allocative efficiency. Can we have allocative efficiency in a monopoly? Is this monopolist allocating efficiently at the quantity Q pi? Well, allocative efficiency happens when the price equals marginal cost. At the quantity Q pi, the monopolist charges the price of P pi, which is not the same as the marginal cost price, because our marginal cost price is here, but this is the price we're charging. So This is a discrepancy, meaning the price does not equal to MC, meaning there is no allocative efficiency. So there is no allocative efficiency. Because monopolies charge a price greater than the marginal cost, that exploits consumers with greater prices and subsequently lower consumer surplus. Furthermore, monopolies are restricting the output, so the quantity could be bigger for allocative efficiency, but monopolists restrict this output so that they can raise the price and maximize profits. Subsequently, we have a high price and a low output. There is limited choice, and resources are not optimally allocated. So again, allocative efficiency is not established here. But what about productive efficiency? Let's talk about productive efficiency. Okay, from the diagram, we could see that even if the monopolists does operate at the average cost curve, they are not at the minimum point of the curve. So P equals minimum ATC is the condition for productive efficiency. We can see that in this situation, they are not producing at the lowest ATC, so there is no productive efficiency. They are voluntarily actually foregoing economies of scale by not producing at the minimum point on their average cost curve.